Hello students, welcome back. This is Dr. Mercado. I hope all of you are doing great and having a fabulous week. This is going to be a continuation of chapter 3, which deals with the double entry framework. Okay, so we're going to continue cover some of your problems that you're going to be seeing on your homework for chapter 3A. So let's go ahead and dive into this particular problem. We are going to be covering in this particular lecture exercise 3-5. Remember to have read the chapter before you attempt your assignments. That way you know what we're dealing with in respect to what is being covered in the problem. Okay, so this is the problem that we're going to be dealing with. It deals with transaction analysis. We're going to be analyzing a variety of transactions and posting them into the accounting equation. Okay, so it says Linda Kipp started a business on May the 1st. We're going to analyze the following transaction for the first month of the business using T accounts. We have to label each T account with the title of the account affected and then place the transaction letter and the dollar amount on the debit or credit side. And remember, in accounting, debits must always equal your credits. That is the rule in accounting. So we have 5 transactions that we're going to analyze. Now, the focus is exercise 3-5. That is what you're going to be having on your homework. But I'm also going to cover exercise 3-6 in the process, because exercise 3-6 is the following step, which is to foot and balance your T accounts. That way you know how to do a T account from beginning to end. Okay, so let's get started. So the first transaction that we have here is we invested cash in the business, $5,000. So the problem states that we are opening up or starting up our own business in the month of May. So I've got my accounting equation here on the right hand side, which is your assets equals your liabilities plus your owner's equity. Okay, so assets is anything that you own, liabilities is anything that you owe, and then owner's equity is your capital, and it's also composed of your drawing, your expenses, and your revenues. Okay, so we have a lot of things going on under your owner's equity section. Okay, so this is what the accounting equation looks like. I've already set it up for you, and then I've set up the different accounts that we're going to be using for purposes of time constraints. That way you know this is what we're going to be using. So we invested cash in the business, and this is where we do the talking to ourselves. What is going on here? Well, I'm Linda, and I put in $5,000 of my personal money into the business. Okay, so what is happening to the business? Well, the business is receiving those $5,000, so now the business has $5,000 more. Because we have $5,000 more, my cash is increasing. And on an asset account, if an asset increases, you debit the account. Okay, so I'm going to have here letter A, because this is transaction A, and my cash increased by $5,000. Now, what happened in addition to the business receiving $5,000? What happened? Well, Linda invested money, so now she has investment ownership share in the business. Okay, so she invested her money. Now she has some capital in the business. Okay, so now we have to record the capital component of the transaction. My capital is increasing. For purposes of my owner's equity section, if it increases, my capital increases, I am going to credit my capital. So I'm going to go ahead and I'm going to do letter A here, and my capital is going to be credited. So if you notice here, cash gets debited, capital for Linda Kipp gets credited. One debit, one credit, we are in balance. So every time someone invests either money or they can invest maybe equipment or like an automobile or land, whatever the case might be, the capital account for that person will be increasing, and you increase that with a credit to the capital account. Okay. Letter B, you bought equipment for cash, $700. So what did we buy? We bought equipment. So do you have more or less equipment now? Well, if you bought the equipment, you should have more equipment. So you own the equipment because you bought it. Okay. Equipment is an asset account. Okay. And if you have more, then you're going to be debiting your asset account. Okay, so this is letter B, and you bought equipment for $700, so your equipment is going to increase. How did you pay for the equipment? It says here that you paid with cash. Okay, cash is also an asset account, but in this case, what's happening to your cash? If you buy something and you pay cash, your cash decreases. So if your cash decreases, then you need to credit your account. So cash is going to be credited for the $700 that you paid for your equipment. So if you notice here, equipment gets debited, cash gets credited $700. So in this particular situation, both the debit and the credit were on the left hand side of the accounting equation because they're for the same amount. There's really no impact on the accounting equation overall. It's just we're transferring from one account to the other. Equipment increased, cash decreased. Okay. Letter C. You bought more equipment, but this time you bought it an account, $600. So you bought it, but you're going to pay it later on. Okay, so letter C. You bought equipment for $600. So do we have more or less equipment? Well, we have more equipment because we purchased equipment for $600. Okay. How did you pay for your equipment? It says on account. If it's on account, it means you owe the money. If you owe the money, that means it's a liability. Okay? So your liabilities is increasing. Why is the liability increasing? Because you owe someone more money. So as your liabilities increase, you will be crediting your liability account, which is accounts payable in this case. So for letter C, your liability accounts payable is going to be increased by crediting it $600. So I've got a debit to my equipment, increasing my equipment balance. I've got a credit to my accounts payable, increasing my liability account. Okay, and these are the normal balances of your account. Okay, those are very important that we know. Okay, what causes an asset to increase or to decrease? Okay, it's very important that we know the difference. Okay. Okay, letter D. You paid cash on account for equipment purchase in transaction C, $400. So we owed $600 and later on in the month we decided to make a partial payment of $400. So that equipment that we bought for $600 that we owe, so this shows that we owe $600. Now we are making a payment of $400. So because we are making a payment, what's going to happen to my accounts payable balance? Is it going to go up or down? If you're making a payment on something that you owe, then your accounts payable, your liability is going to decrease. If your liability decreases, then you debit your account. Okay, this is letter D. So I'm going to debit my accounts payable for $400 to decrease the balance. Now, it says that you paid cash. So what's happening to your cash if you make a payment? Your cash is going to go down. Okay, so your cash is going to decrease. You decrease cash by crediting it at $400. So accounts payable gets debited $400 to decrease your liability. Cash is credited $400 to decrease your cash. Okay. Last but not least, it says here that we withdrew cash for personal use, $900. So the owner, Linda Kip, decided to make a withdrawal of $900 for personal use. Okay. Well, what's going to happen to the cash in the business if you withdraw money? It's going to go down. Okay. So your cash is going to decrease, letter E, and we decrease cash by crediting it. Okay. If your cash is going down, it's decreasing, we're going to credit it. Okay. And it says here that you withdrew cash. If you withdrew cash, then we have an account called a drawing account. And this drawing account keeps track of all of the withdrawals done by the different business owners. So your drawing account is going to be debited. Why? Because your drawings are increasing. Every time that you do a drawing, we have to keep track of it. So your drawing will be, normal balance is a debit. So I'm going to go ahead and I'm going to debit, let me see, Linda Kip drawing for $900. So the drawing account gets debited, cash gets credited. Okay, so those are your transactions A through E. Okay, so we've recorded them into our accounting equation. This is what our accounting equation looks like. Okay, so you go through each transaction. You need to make sure that you post the debit and the credit. Make sure that you analyze the transaction, understand what's going on, and understand what accounts are being affected. Now, exercise 3-6 says, foot and balance the T accounts. What does that mean? Well, that means that we have to balance our account, okay? So, if there's more than one transaction, we have to foot our account, okay? We need to figure out what the balance is, okay? Now, let's look at cash first, okay? Cash is an asset account. My normal balance is a debit. Whenever you see the plus sign, that's the normal balance of the account. So my normal balance of my account is right there, the orange one, okay? So more than likely, 99% of the time, your balance when you foot is going to be where the positive or the plus sign is. So in this case, what we're going to do is we're going to go ahead and we're going to get my debit side, which is 5,000. And then I'm going to subtract everything on my credit side, okay? And that gives me $3,000. So that means that that is the balance on my cash account. So 5,000 debits. Now let's add these together. My credits first. 700 plus 400 plus 900. That gives me 2,000. So I've got a debit of 5,000, a credit of 2,000. Which side is greater, the 5 or the 2? Well, the 5. Wherever the highest balance is, that's where you're going to put your ending balance. So what you do now is you get your 5,000 minus your 700, your 400, and your 900, and that's going to give you a balance of $3,000. Okay? And this is the ending balance for your account right there. Okay, for cash. We're going to do the same thing for equipment. Now, equipment only had 2 transactions and they're both on the debit column. So all we have to do is add those two together. Okay, we don't have to make any adjustments here. Just add the 2 together to come up with our ending balance. So at the end of the month, I have $1,300 in my equipment account. Okay, let me just put a little comma there. Okay. So this is the ending balance on my equipment account. I've got $1,300 of equipment for my business. Now for your accounts payable, like I said, always look at your normal balance. Okay, so my normal balance should be a credit. Okay, so that means that my balance should be on the credit column side. So I've got 600, 600 minus 400, that's 200, but let's just still use the calculator. 600 minus 400, that gives me a $200 balance. And it's going to be on the credit side because that's where my normal balance is. Okay, balance of $200. Okay. My capital account, I don't need to foot it because I only have one transaction. My balance is 5,000. And my drawing account, I don't have to foot it because it's just one transaction. My balance is $900. Okay, so those are my ending balances. So footing means that we're just basically getting or obtaining the ending balance on each of our accounts. If we have multiple transactions on the debit and the credit side, we have to figure out what it is. Always look at your accounting equation. Always look at where the positive number is on your accounting equation. That is the normal balance of your account, and that is where 99% of the time your balance should be sitting. Okay? Every time you have an asset, your balance should be sitting on the debit side. Every time you have a liability, your balance should be sitting on the credit side. And on your owner's equity, your balance should be sitting on the credit side. For capital, and then for drawing and expenses on the debit side and revenues on the credit side. Okay, so that is basically exercise 3-5 and 3-6. Very straightforward, analyzing 5 different transactions, posting them into the accounting equation, and then footing your T accounts. Okay, this is fundamentals of accounting. We need to be able to analyze transactions, post them to T accounts, and foot your balances. If you have any questions, please do not hesitate to reach out to me. Please review the different examples posted on your ebook, and that way you can use that for guidance. So that is basically it for this lecture. Until next time, take care.